All right, let's dive in. Today we're talking about something called corporate governance. Now, I know what you're thinking. That sounds super dry, right? But stick with me, because it's actually the secret rulebook that tells the most powerful people in business what they can and can't get away with. It's all about power and accountability.
So, let's kick things off with a big question. You have a boss, I have a boss. But who's the boss of a CEO? Who keeps the board of directors in line? That, right there, is the multi-billion-dollar question at the very heart of corporate governance.
So what is corporate governance, really? Well, at its core, it's a system that steers the ship. Think of a company's director as the captain. Their job isn't just about making themselves rich, it's about navigating some really tricky waters, trying to balance what's best for everyone with a stake in the company, from the shareholders to the employees and even the community.
Right, so every captain needs a compass, a rule book. And for a corporate director, that rule book is absolutely critical. Let's take a look at what's inside.
It really boils down to a few fundamental duties. First, there's the duty of care. That just means you have to actually pay attention. You have to be informed. Then there's the duty of loyalty, which is huge. It means the company always comes first, before your own personal interests. And more, it also means you've got to consider all the stakeholders, not just the bottom line.
Okay, so if you're a director, you've got this incredible thing called the Business Judgment Rule, or BJR for short. Think of it like a legal shield. It's there to protect directors, to let them take smart, calculated risks without having to live in fear of getting sued every time a good faith decision doesn't pan out perfectly. After all, business is all about taking risks. But here's the catch. That shield isn't automatic. You've got to earn it by passing a three-part test. 1. Act in good faith. No shady deals, no conflicts of interest. 2. Exercise due care. You can't just guess, you need to do your homework and be reasonably informed. And 3, you have to rationally believe your decision is actually good for the company. You pass those 3, your shield is solid. So what happens when that shield just completely shatters? Well, now we're going to get into some cautionary tales. Stories where directors failed so badly that no legal shield on earth was going to save them.
And this quote right here from a landmark case just hits the nail on the head. It's about a director named Mrs. Pritchard, and it sets up a principle that echoes through boardrooms to this day. Ignorance is not a defense. You can't just say, "Oh, I didn't know."
And the stakes here were absolutely massive. In the Francis case and another one, Sen, we're talking more than $12 million. And this wasn't just taken from the company, it was siphoned out of client trust funds. This wasn't a small mistake, this was a total meltdown of oversight. So let's look at this story of Mrs. Pritchard. She was a director, a major shareholder, but she was completely absent. Her own sons were looting the company for millions, calling them shareholder loans, and she never, not once, looked at a financial statement, never asked a single question. The court came down hard, saying her neglect basically gave her sons the green light, and they held her personally liable for the whole mess. So this is where it all comes together. You can see the two extremes, right? On one side, you have total negligence, like in Francis, where doing nothing gets you in huge trouble. And on the other, you have a case like Common v. American Express, where the business judgment rule actually protected the directors from making an active, informed decision, even if a lot of people disagreed with it.
See, in that Amex case, the board chose to give out stock as a dividend instead of selling it to get a massive tax write-off, and people were furious. But the board had a reason. They thought a huge reported loss would tank their stock price. And the court basically said, hey, our job isn't to second-guess a business decision that was made honestly and with all the facts. Process mattered more than the outcome.
Okay, so we've seen how individual directors can get it right or get it horribly wrong. But what happens when the fight gets bigger? What happens when it's the entire board of directors versus its own shareholders? Let's dive into some of these epic boardroom power plays.
This is where it gets really juicy. If you're a shareholder and you think the board is running the company into the ground, you have a really powerful weapon. It's called a shareholder derivative lawsuit. It's wild, right? You're basically suing the people in charge for the company you own a piece of. So get this. The boards getting sued came up with a pretty sneaky tactic. They'd create a special litigation committee, made up of their buddies, of course, to investigate the lawsuit against themselves. And, surprise, surprise, the committee would always recommend dropping the case. Well, the courts got wise to this. They created a new, tougher standard, saying, nope, we're not just going to trust your committee. The court itself is going to use its own business judgment to see if this lawsuit has merit. All right, now for a story that's straight out of a movie. A legendary corporate showdown, Unocal versus Mesa.
This was a brutal, hostile takeover attempt. A so-called corporate raider tried to force a sale, but Unocal's board unleashed a legendary defensive move that became known as the poison pill.
So what made Mesa's offer so nasty? It was this two-tiered structure. They offered cash for the first chunk of shares, but everyone who waited got stuck with a bunch of low-value junk bonds. Think about it. It creates this panic, forcing shareholders to sell fast and cheap just to avoid getting completely wiped out. The court saw how coercive this was and said, yeah, Unocal's board has the right to defend against this.
And that brings us to the final act. We've seen directors at work, in boards and battle. But what about the biggest changes a company can go through? Let's talk about the corporate endgame, mergers and acquisitions.
This brings us to a super important legal idea, the de facto merger doctrine. Basically, the courts have a saying, if it looks like a merger and acts like a merger, well, it's a merger. Companies can't just call it something else, like an asset sale, to try and cheat shareholders out of their right to vote on the deal.
And this is precisely what a company tried to do in a case called Ferris. Imagine you own a piece of a small coal mining company, and overnight it's basically swallowed by this giant holding company. Suddenly, your voting power is almost gone, and the entire business you invested in has changed. The court stepped in and said, no way. This is a merger in everything but name, and gave the shareholders the rights they deserved.
And that brings us to our last big idea, summed up perfectly by this quote. It's about entire fairness. And this is especially crucial when you've got a conflict of interest, like when a parent company is trying to buy out the minority shareholders of a company it already controls.
The entire fairness test has two equally important parts. You can't just offer a fair price. That's not enough. The process, the fair dealing, has to be fair too. That means total honesty, total transparency. No hiding the ball.
And in the Weinberger case, this is exactly what went wrong. It's all about a secret report. Some directors were on the boards of both companies, and they had a report that said paying up to $24 a share was a great deal for the parent company. But what did they offer the minority shareholders? $21, and they never showed them the report. That lack of complete candor blew the whole thing up.
So we end up right back where we started. Corporate governance is this constant, high-stakes balancing act. It's the rulebook for the most powerful people in business. But it leaves us with this one final question. In this game of money and power, who really is the final referee? Is it the board? Is it the shareholders? Or, in the end, is it the courts? Something to think about. Thanks for tuning in.